Today is March 22, 12:09 p.m., and we are looking at the market. All three indexes, because the FOMC meeting is today at 2 p.m., and the market is basically flat because everyone is very anxious as to where the market is going to go, if it's going to go up or if it's going to go down after the Fed makes their decision on the Fed rate hike. And so that's the big question now. And so let's take a look at the unusual options, see what is the most unusual for today to see where everybody is positioning themselves, especially the large institutional investors. So we see something here about at 11:32. We can see here this is the June's, but this is at the strike price of 400, and this is the same trade here, 4,000 of these, and it's close to at the money since we're close to 400. The S&P is at 4,000, so this is selling that 400 call and buying the 400 put. So this is a bearish trade. Could be a hedge, but let's kind of take a look at how much it required to put on this trade. Selling that 400 call is about 9,500, and so 4,000 of these. This is a $38 million buying power required trade. So this institution needed to have that amount of money to put on this trade. If we look at the 1054, you see here another trade that is also bearish, but it's a different amount. If you look at, they paid 90 and then they sold it for 20, so it's technically they paid 70. So if it was 70 and you multiply by the number of contracts, 3596, that's only 251,000. So definitely less than the one here placed at 11,432. So that's why we always want to look at the amount that was required. So this is a lot more unusual than the one right below it, even though it's close to 4,000 contracts. This is a lot more unusual because it's $38 million in comparison. So we want to give that a lot more weight in our decision, and because it's a lot more significant if you're putting that much money into it, this trade, right? So let's look at the NASDAQ with the QQQs. So it looks like we have something. Here's another one, like just at 11:30, you could see here 10,000 of these contracts. This is buying it for 76, selling it for 65. So this doesn't look like it'll cost very much. Just simply, if you do the math, it's about $11. 76 minus 65, and then you multiply by 10,000. So this is only 110,000. So still not greater than that 38 million we saw on the SPY. So what we want to do is look for something that is a lot more. Here's a one here at 1156, just recently, 15,000 of them, paying $339. Now 15,000 of them, that was $5 million. So it's still below the 38 million, but it is still quite a significant amount of money that is going bullish on the NASDAQ. This is also a bullish trade here, selling the 280 puts at 1054, 19,500 of them. This one is selling the puts, so they required to have per contract, since they're agreeing to buy it at 280 strike price, 28,000 per contract. buying power. So that's 19,000 of them, 500 of them. So that one required $546 million just to put on this trade. This is a slightly bullish trade, slightly because it can drop from 310 all the way to 280 and still be profitable at expiration date. So keep that in mind. The other one we see here is this 1033, which is also very interesting. 10,000 of these contracts, and you'll see that they sold the 305 puts and bought the 305 calls. So that is to sell that 305 put at that strike price, that also requires let's see, per contract they're agreeing to buy the QQQs at 305, so 30,000 each, 10,000 of these contracts, so that required 305 million buying power. So these trades definitely that are slightly bullish, they are also in greater than 300 million, so it's a lot more than the SPY we were looking at previously at 38 million. So these required a lot more buying power, so much more significant, and it is slightly bullish. So keep that in mind as we look at the last index to see if we have anything greater than these amounts. This is the Russell, the IWM. And let's see, we have these 14,000 contracts here at 955. So this looks like they're selling the 170 puts and buying the 180 calls. And so how much is that going to cost? 170 puts. So per contract, it's 17,000 since they did 14,000 of them. This costs $238 million in buying power, and it is also a slightly bullish trade as well. So this is a position where if it drops to 170, we're at 175 now, it is still profitable, these trades, this put selling here, and so all these other calls here, you see these 10,000 calls that are also quite bullish. They're paying very little for these. They're only like $23 each, so it's not going to be as much in comparison to this amount of money. So and the last one we're seeing here, this one looks like this is a bearish trade where they're selling the 190 calls and buying the 175 puts. However, since this doesn't look like it's going to cost more than 238 million, this is a lot less. So we're going to take this amount, this unusual options as being the more significant one on this trade, this ticker on the Russell. So overall, it looks like based on that, the NASDAQ with those very large options, it's the market is pricing in, well, the large institutional traders have more of a slightly bullish view because of these puts and this the contracts that we saw here earlier. So if you like this video, give us a thumbs up. If it's helpful to you, giving you value, like it please, and it really helps us make more videos like this. And hit the bell icon and you get notified whenever we see these unusual options. 2 p.m. FOMC meeting, and good luck everyone. We have just about less than 2 hours left, and the final countdown has begun, and we will see what happens to the market after Jerome Powell speaks. Take care, everyone.